Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Second charge mortgages. Navigating the world of mortgages can be a complex journey, especially when considering additional borrowing options. Second charge mortgages are one such option that might be suitable for homeowners in the UK who are looking to borrow against the equity in their property. Essentially, a second charge mortgage is a secured loan that uses your home's capital as collateral and is separate from your original mortgage. This type of mortgage can be useful for home improvements, debt consolidation, or other large expenditures. What is a second charge mortgage? A second charge mortgage is a secured loan that you can take out while you still have an existing mortgage on your home. This type of borrowing is also commonly referred to as a second charge or simply a secured loan. It uses the equity in your home as collateral, and it's entirely separate from your original mortgage. The purpose of a second charge mortgage is often to finance substantial expenses such as home improvements, renovations, or debt consolidation. You may also find it helpful for funding other large purchases that might not be within the scope of your first mortgage. It's important to note that this type of loan is not an increase on your current mortgage, it's actually a completely new loan from a different lender. Second charge mortgages might be useful in certain situations where you don't want to refinance your existing mortgage. For instance, if your first mortgage has a low fixed interest rate or an early repayment charge, it may be more cost-effective to take out a second charge mortgage for additional secured borrowing. Moreover, since this is a separate loan, it doesn't affect your first mortgage, allowing you to maintain the financial arrangements you initially agreed upon. To secure a second charge mortgage, you need to have sufficient equity in your property. The equity represents the difference between the value of your home and the amount you still owe on your original mortgage. Lenders take into account this difference and adjust the interest rates, loan amounts, and terms accordingly. Keep in mind that as a borrower, taking out a second charge mortgage comes with its risks. As with any secured loan, your home is at stake if you fail to meet your repayments. It's crucial that you carefully evaluate your financial situation and weigh the pros and cons before proceeding with this type of borrowing. Comparison with first charge mortgages. In the UK, there are two types of mortgages, first charge and second charge mortgages. To help you understand the differences and make informed decisions, let's compare them. A first charge mortgage is the primary mortgage on your property. It is essentially a loan that you take out to buy a home, using the property as collateral. These mortgages come with different interest rates, terms, and repayment options. When considering a first charge mortgage, it's essential to compare various lenders to find the best deal for your situation. On the other hand, a second charge mortgage is a secured loan taken out in addition to your first mortgage, using the equity in your property as security. These loans are often used by homeowners who need additional funds but do not want to remortgage their property. Second charge mortgages are typically useful for consolidating debts, funding home improvements, or financing a large purchase. While both first and second charge mortgages are secured loans, there are differences in terms of risk and homeowner benefits. Risk. With second charge mortgages, the risk to the lender is higher because the first charge mortgage takes priority in case of a default. This means that if you're unable to repay your loans, the first charge mortgage lender will receive their funds before the second charge mortgage lender. Due to this increased risk, second charge mortgages usually have higher interest rates than first charge mortgages. Secured loans, both first charge and second charge mortgages are secured against your property, which means that your home is at risk if you fail to make repayments. However, as mentioned earlier, the first charge mortgage has priority should a default occur. Homeowner considerations. If you're considering a second charge mortgage, it's crucial to weigh the benefits and drawbacks. While these loans can provide much-needed funds, they also mean that you'll have two mortgages on your property. This can make managing your finances more challenging, so it's essential to ensure that you're comfortable with the additional financial commitment. In conclusion, when choosing between a first charge and a second charge mortgage, it's important to consider your individual financial circumstances and the associated risks. By understanding the differences and evaluating your options, you can make the best decision for your personal situation. The application process. When you apply for a second charge mortgage in the UK, there are several steps that you can expect to go through. Your lender will carry out various checks to ensure that you can afford the additional mortgage, and that it's a suitable option for your financial situation. Firstly, you will need to provide information about your income and expenses. This is important, because affordability checks will be conducted by the lender to evaluate whether you can realistically manage the extra repayments. Be prepared to provide payslips and bank statements, and if you're self-employed, your tax returns and business accounts will be required. Once the affordability checks are complete, your credit rating will be assessed. A higher credit score usually translates to better interest rates and more favorable terms. If you have a lower credit score, you may still have options, but be prepared for possible higher interest rates or a need to provide additional security. Keep in mind that maintaining a positive credit history, paying bills on time, and reducing outstanding debts can significantly improve your credit score. During the application process, the lender will also consider the equity available in your property. The amount you can borrow with a second charge mortgage depends on the difference between the current value of your home and the outstanding balance on your existing mortgage. It's essential to accurately estimate your home's worth and to avoid overextending yourself. Finally, your lender may charge fees for setting up the second charge mortgage, such as arrangement or valuation fees. Make sure you thoroughly understand the fee structure and factor in all costs when assessing which second charge mortgage is best suited to your needs. Throughout the application process, it's crucial to be honest and transparent with your lender about your financial situation. Providing accurate and up-to-date information will increase your chances of being approved for a second charge mortgage and obtaining the best possible terms for your individual circumstances. Interest rates and charges. When considering a second charge mortgage, it's important to understand the interest rates and charges associated with this type of loan. Since the rates and charges can vary, it is essential to compare different lenders and products to find the best deal for your situation. Interest rates for second charge mortgages can be either fixed or variable. With a fixed rate, your monthly repayments remain the same for a predetermined period, offering you stability and the ability to budget. On the other hand, variable rates can fluctuate based on market conditions, which might affect your monthly repayments. Some lenders may also offer discounted variable rates for an initial period, followed by their standard variable rate. It is crucial to factor in the potential costs of early repayment charges when considering a second charge mortgage. If you decide to pay off your loan ahead of schedule, some lenders might impose a penalty for doing so. Early repayment charges can be a percentage of the outstanding balance or a fixed amount, and they may decrease over time. Before committing to a second charge mortgage, ensure you understand the early repayment terms, as they can impact your ability to switch or pay off your loan sooner. When comparing second charge mortgages, don't forget to account for other fees and charges. These can include arrangement fees, valuation fees, and legal fees. Each lender may have different fee structures, so it's essential to include these expenses in your calculations to get a clear picture of the overall cost of borrowing. Lastly, remember to review how your credit score and personal circumstances might affect your ability to secure a favorable second charge mortgage rate. Lenders will assess factors such as your credit history, affordability, and employment status when determining the interest rate offered. Taking the time to understand and compare interest rates and charges associated with second charge mortgages will help you make an informed decision and ensure you find the most suitable loan for your needs. Risks and considerations. When considering a second charge mortgage, it's essential that you understand the potential risks involved and weigh them against possible benefits. Here are key aspects to consider before making a decision. One major risk associated with second charge mortgages is the possibility of your home being repossessed if you fail to keep up with repayments. Since your home serves as security for the loan, lenders have the right to take possession of your property to recover their money. This would be a worst-case scenario, and every effort should be made to keep up with repayments to avoid this outcome. Another important consideration is the impact on the equity in your home. Taking out a second charge mortgage reduces the amount of equity you have, which affects your overall financial stability. Ensure you have a clear understanding of how your equity will change, and consider the long-term implications of this reduction on your financial standing and future borrowing potential. It's also essential to be aware of how market conditions can affect second charge mortgages. Fluctuations in interest rates can result in changes to your monthly repayments. Make sure you understand what type of interest rate you're signing up for, fixed or variable, and consider the possibility of rates rising during the loan term. This will help you plan and manage your finances accordingly. Another potential risk is the cost of fees and charges associated with second charge mortgages. These may include valuation fees, legal fees, arrangement fees, and early repayment charges. Ensure you factor in all these costs when calculating the overall expense of your second charge mortgage. It's essential to know exactly what you're committing to before entering into an agreement. By understanding the risks and considerations of a second charge mortgage, you can confidently make an informed decision. Consider seeking professional advice from a financial expert or mortgage broker before taking the plunge, as they can help guide you through the process and help find the best solution for your specific needs. Alternatives to second charge mortgages. When considering ways to raise funds using your property, it's essential to explore alternatives to second charge mortgages. There are several options available to you, such as remortgaging, personal loans, unsecured personal loans, and further advances. Remortgaging involves switching your current mortgage to a new lender or negotiating a new deal with your existing lender. Remortgaging can be advantageous if your property has increased in value since you took out your initial mortgage. This may allow you to borrow more money at a lower interest rate, especially if you have a good credit score. However, be cautious of any early repayment charges associated with your existing mortgage and arrangement fees for the new mortgage. You can find more information on remortgaging at Money Helper. Personal loans are another option to consider. Personal loans can be unsecured, meaning they do not require collateral, such as your property. The interest rate on personal loans is usually higher than second charge mortgages and remortgages, but they can be a suitable choice for smaller amounts or if you prefer not to tie additional borrowing to your property. Ensure you can afford the regular repayments, as failure to repay the loan may lead to legal action. Unsecured personal loans work similarly to personal loans, as they do not require your property as collateral. However, they usually come with higher interest rates compared to secured options. Unsecured personal loans are beneficial if you have a good credit score, stable income, and are looking to borrow a smaller amount, as the approval process is generally quicker than secured loans. Finally, a further advance is another alternative to a second charge mortgage. A further advance is an additional loan, secured against your property, from your current mortgage lender. This option is helpful for home improvements or debt consolidation, and the interest rate is usually competitive. But bear in mind, failing to repay the further advance may put your property at risk. In conclusion, carefully consider the available options and weigh the pros and cons of each alternative to make the most informed decision. Always consult a financial professional for tailored advice to your specific circumstances. Benefits and disadvantages. When considering a second charge mortgage, it's essential to weigh the pros and cons in the context of your personal and financial circumstances. Here is a brief overview of the advantages and disadvantages of second charge mortgages. Benefits. Access to higher credit amounts. A second charge mortgage allows you to borrow a larger sum of money, especially if you have built up substantial equity in your home. Avoiding fees. It can help you avoid certain fees associated with other types of equity release options such as early repayment charges, IRCs, or penalties. Flexibility. You have the freedom to use the loan for various purposes, from home improvements to debt consolidation, depending on your needs. Disadvantages. 2 mortgage debts to repay. With a second charge mortgage, you'll need to manage and repay both your primary mortgage and the second charge, which can be challenging in some financial situations. Higher interest rates. If your credit rating isn't good, you're likely to face a higher rate of interest on the second charge mortgage compared to other secured loans. Longer time to own property outright. Adding a second charge mortgage increases the length of time before you can fully own your property, as you'll need to pay off both loans. Rigorous application assessments. Lenders will scrutinize your financial standing and credit history, which can be time-consuming and overwhelming for some borrowers. Risk of losing your home. Failing to meet the repayments on a second charge mortgage could result in losing your home, as it serves as collateral for the loan. As you weigh the benefits and disadvantages of a second charge mortgage, Make sure to assess your personal circumstances and financial capacity to determine if it's the right choice for you. Remember that a confident, knowledgeable, and neutral approach will be crucial in making a well-informed decision. Using second charge mortgages for specific purposes. A second charge mortgage can be a practical solution when you want to raise funds for specific needs without refinancing your existing mortgage. In this section, we will explore some of the most common purposes for taking out a second charge mortgage. One popular reason for obtaining a second charge mortgage is to finance home improvements or renovations. If you're looking to expand your home, such as adding an extension or converting your loft, a second charge mortgage may be a suitable option. By investing in your property's improvement, you could potentially increase its valuation, which can benefit you in the long run. Another reason to consider a second charge mortgage is to consolidate your debts. If you have multiple high-interest loans or credit card debts, consolidating them into a single, more manageable second charge mortgage can help reduce your monthly repayments and make it easier for you to clear your debts. However, it's important to bear in mind that spreading your debt over a longer term could result in higher overall interest costs. When exploring the possibility of a second charge mortgage, it's crucial to weigh the benefits against the potential risks. It's essential to assess your financial situation carefully, take into account your property valuation, and ensure you can comfortably afford the monthly repayments. Consult with a professional financial advisor to help you make an informed decision. Remember, a second charge mortgage uses your home as collateral. If you fail to make the required repayments, you may be at risk of losing your property. Therefore, consider all available options and thoroughly evaluate the implications of taking out a second charge mortgage for your specific needs. Regulations and legal aspects. In the UK, second charge mortgages are regulated by the Financial Conduct Authority, FCA, to ensure that borrowers are treated fairly and lenders adhere to proper practices. The regulation of second charge mortgages came into effect on the 21st of March, 2016, as part of the implementation of the Mortgage Credit Directive, MCD. As a borrower, it's essential for you to understand that second charge mortgages are secured loans on your property. Your property is already subject to a first-ranking charge mortgage, making the second charge an additional loan. These loans can include residential and commercial properties, but do not cover buy-to-let properties falling within the exclusion of Article 61A of the Financial Services and Markets Act 2000. The FCA requires lenders and intermediaries involved in second charge mortgages to follow specific rules. The Good Practice Guidelines for Second Charge Mortgages outline how lenders should treat borrowers experiencing difficulties in making repayments. This includes considering each case individually, taking into account all relevant circumstances. When dealing with a second charge mortgage, it is crucial for you to be aware of your rights. As a second charge holder, lenders have the right to seize your property and force a sale to recoup the borrowed amount if the mortgage falls into arrears. However, bear in mind that lenders must follow the FCA rules and guidelines in the process. In conclusion, understanding the regulations and legal aspects surrounding second charge mortgages in the UK is vital to ensure your interests are protected. By adhering to the FCA's rules, both borrowers and lenders can work together to create a fair and transparent environment for second charge mortgages. Conclusion. In summary, second charge mortgages can be a viable option for you if you're looking to borrow additional funds while maintaining your current mortgage. They can offer more flexibility and ease of access compared to remortgaging or taking out a personal loan. With a variety of UK banks and building societies offering second charge mortgages, it's important to evaluate your financial situation and make an informed decision. Keep in mind that to qualify for a second charge mortgage, you need to demonstrate the amount of equity in your property and prove your ability to manage repayments on both mortgages. Interest rates for second charge mortgages can range from 3.5% up to 17% depending on the lender and your circumstances, so it's essential to compare available options. As with any financial commitment, it's crucial to understand the risks and potential impact on your overall financial well-being. Be mindful of the fact that second charge mortgages are secured against your property, and that failure to meet repayments could lead to the loss of your home. It is recommended to seek professional advice to select the most suitable solution for your needs. In taking this route, ensure that you're familiar with the FCA mortgage rules governing second charge mortgages, which are designed to protect borrowers and ensure responsible lending practices. By considering all aspects, you can make a confident and informed decision in opting for a second charge mortgage. What is the eligibility criteria for a second charge mortgage? To be eligible for a second charge mortgage, you must meet specific requirements. First, you need to be a homeowner, but you don't necessarily have to live in the property. Second, you must have some equity built up in the property to qualify. The amount a lender is willing to offer depends on the lender's criteria and your financial circumstances, including your income and existing financial commitments. Are there any advantages to a second charge mortgage? A second charge mortgage can be advantageous for various situations, such as consolidating debts, funding home improvements, or paying for education expenses. It could offer lower interest rates compared to unsecured loans and allow you to keep the current mortgage deal without refinancing. How do I calculate the potential borrowing amount for a second charge mortgage? To calculate the potential borrowing amount for a second charge mortgage, you need to know the total equity in your property and the lender's maximum loan-to-value (LTV) ratio. For example, if your property is worth £300,000 and your outstanding mortgage is £120,000, you have £180,000 of equity. If the lender caps the second charge borrowing at 75%, you could borrow up to £105,000 as a second charge mortgage. Which lenders offer the best rates for second charge mortgages in the UK? The best rates for second charge mortgages in the UK can vary depending on your circumstances and preferences. Rates typically range from 3.5% up to the top end of 17%. To find the best option, it is recommended to shop around, compare rates, and consult with a professional mortgage advisor. What is the process for obtaining a second charge on a property? Obtaining a second charge on your property requires following several steps. First, research your options and understand the implications of a second charge mortgage. Next, consult with a professional mortgage advisor and gather all required documentation. You'll then need to complete an application, followed by a property valuation and legal work. Finally, if your application is approved, the funds will be released, and your second charge mortgage will be in place. How does a second charge mortgage compare to remortgaging? A second charge mortgage and remortgaging are different methods to borrow additional funds using your property's equity. Remortgaging involves replacing your current mortgage with a new one, potentially with better terms or a larger overall loan. In contrast, a second charge mortgage allows you to take out another mortgage secured against your property, in addition to your existing one. Each option has its pros and cons, and the best choice for you depends on your specific circumstances and financial goals. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.